Hi, this is Stuart Cooper, and today we're going to talk about how do you absolutely get the best rate possible on your next mortgage. And by far, this is probably one of my favorite subjects. I love to discuss. I love to share this with clients because it's a real eye-opener. We're going to look at, does it make sense to buy the interest rate down? Do you want to pay points to get a lower interest rate, or do you want to take 0 points and get par pricing, or even better, or worse, depending on how you look at it, do you want to get a lender credit to cover your closing costs and pay a higher interest rate? Now, those are the key questions that you should ask yourself. And what we're going to do is we're going to break that all down, because what it comes down to is the advice that you get or decide on is going to really depend on how long you have that mortgage. So it doesn't really make sense to pay points if you're going to pay off the mortgage in a few months. So if you're flipping a property and you're going to sell it within a year, I wouldn't pay any points at all, and I would get a lender credit. But we're gonna break this all down, and I'm going to show you exactly what you should be looking at when you're comparing different lenders. And if the lenders aren't doing this, then you need to work with the lender that will, because by doing this analysis, you're going to get real detailed information about exactly how much the loan's going to cost you. And what I always call it is a true cost analysis. And I've been using this strategy for over 30 years, and by far, it's the smartest, best thing that anybody can do when it comes to getting a loan. So let's go ahead and get started. So what we're going to do now is we're going to take a look at the 30-year fixed rate conforming pricing. This is of June 30th, 2022, and we're just looking at a purchase price of $800,000 at a loan amount of $640,000 or 20% down. And this is going to be like a kind of typical what you're going to see from a loan officer when they're looking at interest rates. So when you plug in all the information, it comes back with certain interest rates. So you can kind of see here 30-year fixed rate. Look, you see, you can get a rate as low as 4.125 today, 4.125%, but it's going to cost you almost 4 points. All right, so you can see how points come into play. Wow, you can pay all this upfront cost to get a lot lower interest rate. You can see how higher the interest rate, the lower points. But we're gonna focus a little bit lower down. We're gonna go down to because typically borrowers don't usually pay more than a point or so, maybe even 2 points. But you can see there's a pretty big spread right here between 4.5 and 4 5/8. There's a 3/4 point difference in cost. So that's a lot more expensive. But we're gonna break this down. So what we're gonna do is we're just gonna focus on four numbers, right? So we're gonna look at 4.625 at the borrower paying 1.25 points. So that means they're buying down the interest rate 1.25 points. But you can see here, as the interest rate goes up a little bit, an eighth higher, it cuts the points in half, only 5/8 of a point. And then 4.875 is an eighth cost. And then down here, 5% is at a 3/8 lender credit. So that's the scenario that we're going to work with. And then what we're going to do is, if you're like most borrowers, you're like, well, what does that mean? It's like, well, what's the difference in payment? Oh, it's $100 or whatever it is. So what we're going to do is we're going to really break it down, and I'm going to show you how you should really analyze this. And this is the most effective strategy possible when it comes to choosing a mortgage. So now what we've done is we have 4 different loan options, right? So the same sales price, same down payment. The only thing that's changing is the interest rate and the points. So you can see the variations. 4.625 is costing 1.25 points, or about $8,000. And then 4.75 at 5/8 at a point, which is equivalent to $4,000 to buy down the interest rate. And then you can see here 4.875, it's an eighth of a point cost, or $800. And then we have 5% with a lender credit of 3/8 of a point, or $2,400. So that breaks down all our variables. So now we're looking at all these different loan options, right? And then what we're going to do is we're going to go down here, and you can see on a monthly basis, this is comparing the most expensive rate to the lowest rate. So you can see here, 4.625 will save you $145 compared to 5%. So is it worth to pay that extra, almost $10,000 to save $145 a month? Probably not. But that's what that's what we're doing, is we're doing a comparison. So that's why when I started talking to you about doing time frames, that's why it's so important. So let me just reach out of here, okay? So I like to start off with the what should we look? We'll look at, let's say you're going to have the mortgage for 3 years. All right. So we're going to look at these numbers. So does it make sense, if you're going to only have this mortgage 3 years, does it make sense to buy down the interest rate to get the more affordable payment? Well, we can go down here, and here's my analysis down here on 30 months. Okay. So here's the analysis based on 30 months. You can see buying down the interest rate was a waste of money. The best option would be, if you're going to keep this loan, was to get the lender credit. And by doing that, you save $4,417 compared to the 30-year fixed rate of buying it down in interest rate. And what we're looking at and how we're breaking this all down is we're looking at the total cost. And this number is the interest paid, right? It's the interest plus your closing costs. So you add these two numbers together, and that gives me the total cost of the loan, because that's what it costs you over 30 months. Because a lot of times lenders don't talk to you or don't do analysis based on the points and costs you paid to actually get the original loan. They just look at the interest paid. But you see, what I did is we looked at the total cost, because it's the amount of interest you paid and the closing cost up front. You add those two numbers and divide, and that's how much you're going to pay. That's how much you paid based on this time frame. So $85,777, or you could have gone with the 30-year fixed rate at 5%, and their total cost is $81,000. So based on this analysis, the 30-year fixed at 5% would be your absolute best option, right? Pretty straightforward. But let's change things a little bit. Let's really dig in deep, right? So let's say, hey, you know what? You're going to have the mortgage. Let's say 5 years, right? 60 months. And what you'll see is over time things change. So now you look at this analysis based on 60 months, and the best option right here would be the 30-year fixed, paying down the interest rate. So your break-even point is about 5 years. That's a little bit further out than I like, but that's where it is, right? So that's what it costs, right? So right now, if I go with the 30-year fixed rate and I pay 1.25 points, I'll be $1,500 ahead. And this is where it gets really interesting, all right? And this is why time frames are so important. Now, if I go out, let's say you just for some reason you have the loan for 10 years, right? So 10 years is 120 payments. Now you're going to start to see the impact. So based on a 10-year analysis, you can see here the 30-year fixed rate is by far your best option by paying the points and getting the lower interest rate. But you're going to see a couple things that's kind of interesting. Not only did you save money on the savings, but look at your loan balance. Your actual loan balance is it's almost $6,000 lower compared to this. And that's because the way amortization schedules work is the lower the interest rate, the quicker the principal in the beginning of the loan gets paid off. You're paying a little bit more principal every month. So this is why if you're telling me, hey, I'm going to keep this loan for 10 years, Stuart, we're not moving, this is it, 10-year forecast, I'd say, okay, well, based on a 10-year analysis, the first option would be your absolute best option. And like I said, it really varies with time. So once again, if we switch it, and that's why the time frame is the most important question when we're doing these analysis. So I hope you liked this quick little review of doing analysis on different loan options. If you liked what you saw, go ahead and like my video, and if you could, subscribe to my channel. It would really help me out a lot. All right, have a great day, guys. Take care.